What if I told you, the more you try to beat the market, the more likely you are to lose to it? That sounds wrong. We're taught that smart investors win, that experts outperform. That research beats randomness. But here's the uncomfortable truth. Most professional fund managers with teams, data, and Ivy League degrees fail to beat a simple, boring index fund. And not by a little, by a lot. So today we're breaking down what index funds actually are, why they quietly crush most investors, and why trying to outsmart the market usually backfires. By the end of this video, you'll understand why some of the smartest investors in the world recommend the most boring strategy imaginable. Let's simplify this. An index fund is just a basket of stocks that tracks a market index. In the US, the most famous one is the S&P 500. That index holds 500 of the largest publicly traded companies in America. When you buy an S&P 500 index fund, you're not picking Apple. You're not betting on Tesla. You're not choosing winners. You're buying a tiny piece of all 500 companies. If Apple goes up, you win. If Microsoft goes down, you're cushioned. If one company fails, the index automatically replaces it. It's self-cleaning capitalism. Other countries have their versions. In the UK, there's the FTSE 100. In Canada, the S&P TSX Composite Index. In Australia, the S&P ASX 200. Instead of trying to find the next big winner, you own the entire economy. But wait, if it's that simple, why doesn't everyone just do this? Because humans hate boring. Here's what most people do instead. They chase hot stocks. They panic during crashes. They buy high. They sell low. And they think they're being strategic. Let's zoom out for a second. Every time you buy a stock, someone else is selling it. For you to beat the market consistently, you have to be smarter than the person on the other side of that trade. Who might that be? A hedge fund? A pension fund? An algorithm trading in microseconds? You're not competing against beginners. You're competing against professionals with billion-dollar research teams. And statistically, most of them still lose. Year after year, the majority of actively managed funds fail to beat their benchmark index over long periods. Not because they're stupid, but because fees, taxes, and mistakes compound against them, and compounding works both ways. In 2008, one of the greatest investors ever, Warren Buffett, made a public bet. He bet that a low-cost S&P 500 index fund would outperform a group of hedge funds over 10 years. On one side, elite hedge fund managers. On the other, a simple index fund. The result? The index fund won. By a wide margin. The hedge funds charged high fees. They tried to time markets. They tried to rotate sectors. The index fund just existed and compounded. Buffett later said, for most people, the best thing to do is own a low-cost index fund. Not trade, not speculate, not chase trends. Own the market. But here's the real reason index funds win. And it's not just about fees. It's about behavior. Let's talk about something uncomfortable. The biggest threat to your returns isn't the market. It's you. Studies show the average investor significantly underperforms the funds they invest in. How? Because they buy after rallies. They sell during crashes. They panic in recessions. They get greedy in bubbles. An index fund forces discipline. It removes decision fatigue. There's nothing to tweak, nothing to optimize, nothing to obsess over. You just buy, hold, and add consistently, over decades. And here's the magic. Markets trend upward over long periods because economies grow, companies innovate, population grows, productivity increases. When you own the index, you own human progress. Now let's break it down with simple math. Imagine two investors. Investor A uses an active fund charging 1.5% annually. Investor B uses an index fund charging 0.05%. That difference seems tiny, It's not. Over 30 years, that fee gap can eat hundreds of thousands of dollars from a retirement portfolio. Fees compound negatively. And here's the brutal part. Even if an active manager beats the market, they have to beat it by enough to overcome their fees. Most don't. Now add taxes. Active funds trade more. More trading means more taxable events. Index funds trade less. They're tax efficient. Less friction. More compounding. Over decades, friction is everything. So, does this mean index funds are perfect? No, they're just optimal for most people. Index investing isn't exciting. You won't have great dinner party stories. You won't brag about picking Nvidia early. You won't feel like a Wall Street genius. But you'll likely outperform most people trying to be one. In the US, many investors use total market funds like the Vanguard Total Stock Market Index Fund. In global portfolios, some choose broad ETFs like the Vanguard FTSE All-World ETF. The idea is simple: own everything. Keep costs low. Stay invested. Ignore noise. That's it. Here's the paradox. The more effort you put into trying to beat the market, the worse your results often become. Index funds win not because they're aggressive, but because they're humble. They accept that markets are competitive. They minimize mistakes. They let compounding do the heavy lifting. And in investing, patience beats brilliance. If you understood this, you now understand why boring often beats brilliant. And once you truly understand compounding, you'll never look at investing the same way again.